We focus on private label, credit-based student loans. Unlike federal student loans, private loans are fully underwritten to assess creditworthiness and ability to repay, and are typically school certified and co-signed by a parent or guardian. We think investing in student loans is attractive for three primary reasons: the size, quality, and changing nature of the market. Firstly, today, the student loan market is valued at over $1.74 trillion, which represents the second largest consumer debt balance in the United States after residential mortgages. Secondly, by quality of the market, we mean the strong fundamentals. Approximately 91% of all private student loans originated in the 2023-2024 school year were co-signed, which generally perform better throughout credit cycles. They have higher FICO scores versus other consumer loan products that you may see. Thirdly, the attractive growth and a changing regulatory environment of the student loan market is important to examine. From 2008 to 2019, private student loans grew by over 69% when compared to credit card balances, and by over 70% when compared to residential mortgages. We see positive tailwinds from tightening standards, with 90-plus day delinquency rates near record lows today. It's important to look at the regulatory changes that have occurred, in particular the CECL regulations, or current expected credit losses. This requires banks to reserve capital for all future losses expected over the life of an investment, instead of when a probable loss has already been incurred. This is most punitive to private student loans due to their longer duration. This has led many banks, including some of the larger banks in the United States, to sell portfolios that they had on balance sheet to investment firms such as PIMCO. As a result, we are seeing opportunities from banks that need to manage balance sheet constraints on the back of CECL implementation, and two, non-bank lenders who are growing their market share and need to free up capital to originate new loans.
PIMCO evaluates student loan opportunities through a three-step robust process. Firstly, we look at the data and the characteristics of the pool. Secondly, we understand and try to figure out what would happen to this pool in various economic scenarios. Thirdly, we look at the relative value of the pool. We use this data not only to see how the pool would perform in the current economic scenario, but how the pool would perform in various historical scenarios as well, including recessions. In terms of analyzing the pool, we start with stratification of the pool. We look at how the pool is structured in terms of FICO scores, APRs, people who are in school versus graduating, people who are have co-signed as a parent or not. After analyzing the pool in terms of stratification, we want to understand how the pool would perform in various stress scenarios. Lastly, we look at the pool in terms of relative value, whether we're getting compensated for the illiquidity or not. If we were to invest in a hypothetical loan pool today, we would try to find a non-bank partner or a bank lender who is selling the pool. We want to make sure it's for the right reasons, that the loans were originated as per the underwriting standards and are not of lower quality than what they're keeping on their own books. Secondly, we want to make sure that the characteristics of the pool, for example, APRs or FICOs, as the credit quality is maintained and is high. Lastly, we look at the diversification of the student loans. Make sure that students are graduating over multiple years and not just in one particular year. This helps in case there's a recession in one particular year, the whole pool does not get impacted. And because the students are graduating over multiple years, the recession impact is minimized.